Hello friends, welcome to another FNO live session by Sharekhan. This is third session in the series and if you have missed the first two sessions, you can go and find out the link in the comment section of this particular session. Now what we are going to discuss today is understanding options Greek. What are Greeks? Greeks are something that affects the profitability of a particular trade into options. So option pricing जो होता है वो generally बहुत सारे Greek होते हैं जो सारे मिल के option के pricing को decide करते हैं कि प्राइस ऊपर जाना चाहिए मार्केट के साथ या मार्केट ऊपर चला गया, जिससे आज मार्केट ऊपर गया है लेकिन कॉल ऑप्शंस में बहुत ज़्यादा मूवमेंट नहीं हुआ है. सो ऑल दिस थिंग्स, या सपोज आज मार्केट नीचे चला गया और पुट ऑप्शन में मूवमेंट नहीं हुआ है, तो इसका जो रीज़न होता है वो ग्रीक्स होता है. टुडे विल अंडरस्टैंड व्हाट आर द डिफरेंट टाइप ऑफ ग्रीक्स एंड हाउ दे अफेक्ट द ऑप्शन प्राइसिंग. नाउ बिफोर वी मूव ऑन, एन ऑप्शन ट्रेड टू बी सक्सेसफुल इन द मार्केट, there are several forces which need to work in option traders favor. Now these forces collectively are called option Greeks. These forces influence an option contract pricing in real time, minute by minute impact होता है. अगर मार्केट के अंदर वोलेटिलिटी बढ़ गई है, सडनली कोई पॉलिटिकल अनाउंसमेंट हुआ है, तो निफ्टी वहीं होगी लेकिन कॉल और पुट का प्रीमियम बढ़ जाएगा. these are nothing but Greeks. Volatility is a sort of Greek which affects the pricing of an option. Even if everything else remains same at the same level, Nifty is also at the same level. To make matters complicated, these forces not only influence the premium directly but also influences each other. जैसे अगर हम देखेंगे कि अल्फा है, डेल्टा है, डेल्टा is also influenced by volatility. Volatility is also influenced by delta and beta, rho and so many others. So they directly impact pricing of option, they directly impact each other and collectively they impact overall things. Now let's understand what are the different factors affecting option pricing. They are basically divided into two parts: intrinsic value and time value. Now what is intrinsic value? We learned about intrinsic value in the last episode, that any option which gives you minimum guaranteed price is called intrinsic value. So what are the factors that come under intrinsic value? There are two: spot price, that is delta, and the next other one is strike price. Now without understanding these two, without knowing spot price and strike price, you can never find a price of a particular option. For example, Nifty 11,000 call option is trading at what price? I can't say it, okay, I can't give you answer unless and until you say me that okay, Nifty is trading at 10,900, then I can say that maybe the option is trading at around 50 rupees or 45 rupees. Similarly, if you don't give me strike price and you ask me price of a particular call option, that what is Nifty call option trading at, and with Nifty being trading at 10,900, I will not be able to give you an answer unless and until you give me a strike that we are talking about 11,000 strike, because 11,000 strike is trading at around 45 rupees, 11,100 at around 15 rupees and 11,200 at around 10 rupees, so on. So understanding two things, the spot price and strike price is very important when it comes to option pricing and intrinsic value. Now what is the part of time value? As you can see it on the screen, time value is made up of three things: time to maturity, volatility and rho, that is rate of interest. Now what is time to maturity? For example, if you are talking about 11,000 call option of current month, it will trade at around 50 rupees. When you start talking about 11,000 call option of next month, that is for the month of June, it will definitely trade around 150 200 rupees. And if you start talking about 11,000 call option for the month of July, probably the pricing will be somewhere close to 300 rupees or 400 rupees. So pricing depends on how much time is left to maturity. The longer the time to maturity left for the same strike, the price will keep on rolling on the higher side. Now let's talk about volatility. How does volatility impact? If volatility shoots up, the price of an option goes up sharply. If volatility cools off, like it happened day before yesterday when we had election results, puts suddenly started trading at a lot of discount, and option also didn't appreciate it that much. So this was some 4-5 days back when the election results came in. Another important factor is volatility. As we saw during the election time, when market actually moved up by around 80-90 points on the day of election, and the options, that is the put side options, were trading negative by around 50% because the volatility cooled off and the pricing went took a sharp cut because of volatility cooling off. On the call side, although there was a move in favor of call options by around 80-90 points, still we didn't saw much of action happening in call options front, with almost 11,200 call option on that particular day. Despite the move of 100 points close to on Nifty, it was still trading at around flattish levels as compared to the previous day's close. Now let's understand about rate of interest, that is rho. Rate of interest is generally kept fixed at around 10%. Generally we don't change rate of interest for calculation sake of option pricing. It's freezed at 10%, and we just take it at 10% for prolonged period of time. Let's understand Greeks one by one now. The first Greek was intrinsic value, that is spot price, which was, and the Greek for spot price was delta. Now let's understand delta. A typical definition of delta is it measures change in option price for unit change in spot price of the underlying asset. Now this is something which is written as a proper definition. How actually it impacts, that you can see it on the screen one by one. Suppose for example, if someone is buying a 11,000 strike price of a call option, when Nifty is actually trading at 11,000 level, the delta of at the money. Now when Nifty is trading at 11,000, you are buying a 11,000 call option, the delta for a at the money call option will be 0.5. Any stock, any index, at the money call option delta is always 0.5. As in move, when you move towards out of the money call options, that we learned in the previous FNO live. For example, if you move to 11,100, 200, 300, 400, 500, the delta will keep on falling by some difference, maybe from 0.5 to 0.4, 0.2, 0.3, 0.2, 0.1 and so on. When you go in the money, when you start going in the money, the delta will keep on rising from 0.5 to maybe 0.6, 0.7, 0.8, 0.9, and it cannot go beyond 1, because whatever happens, option price cannot increase more than the price of the underlying asset. So delta on the higher side cannot go beyond 1. Now when 11,000 is where the Nifty is trading, you are talking about you are trading into 11,000 call option with delta of 0.5 and option price being 100. When the price of the underlying asset moves from 11,000 to 11,100, as you can see on the screen, the price of the option becomes from 100 rupees to 150 rupees. How? 100 rupees move in the underlying asset into 0.5, that is value of the delta of that particular option, and you get 50 rupees incremental price. So 100 becomes 150 rupees. What happens when Nifty goes to 11,300? To my understanding, it's very simple. 300 point increase in Nifty, which means 0.5 into 300, 150 rupees. So 100 plus 150 is 250 rupees. But is 250 a right answer? No. 250 is not a right answer, because when 11,000 call option which you have bought and Nifty is at 11,000 level, when Nifty move from 11,000 to 11,300, this particular option becomes deep in the money, okay, and it will have some intrinsic value. What will be the intrinsic value? Intrinsic value will be nothing but 11,300, that is spot price minus the strike price of the option, that is 11,300 rupees is the intrinsic value, which is minimum value guaranteed for that particular option on that particular day if it is a expiry day, right? Now you add some premium to it, so it becomes 300 rupees plus. Now why does it happen? Because we just talked about that as and when the option becomes in the money, the delta keeps on rising from 0.5 to 0.6, 0.7, 0.8 and so on. That is the reason that the option increases more than according to 0.5 delta. So the delta itself goes up. Now let's understand the next Greek, which is the most important Greek for any trader. And in my mind, this is something that can act as a villain in your overall trade setup. Theta is the next Greek. It measures the change in option price per day change in time to expiry. Now theta has a direct correlation with time lapse. Supposing you have bought an option with 30 days left to expiry, after 5 days the option price will decline because you have already passed on 5 days after the trade has started, and the theta which keeps on adding up for those 5 days is deducted from the overall option pricing. For example, spot price is 11,000 level on Nifty, strike price is 11,000, theta is negative 4 rupees, option price is 100 rupees, time to expiry left is 26 rupees. So after a day, the same 100 rupees option will start trading at 96 rupees because 4 rupees is theta. After 5 days, this option will start trading at 80 rupees, and after 10 days, this option will start trading at 60 rupees. Now, does exactly happens when you trade? No. For simplicity's sake, we have kept the theta at constant at around 4 rupees, as you can see it on the screen. But in real life, theta generally keeps on increasing as and when you progress towards expiry. For example, 30 days before, a 100 rupees option will go down by hardly 1 rupee 20 paisa at the end of the day because of time lapse. After 5 days, the same option will start deteriorating by 3 rupees, 4 rupees, and towards the end of the expiry, that is on the last day, the option will have a value of 20 rupees still left in it. That is typically option trade at around 20-25 rupees one day prior to the expiry, which means out of 100 rupees, 20-25 rupees has to become 0 on the last day, and the rest 75 rupees has to become 0 in those 29 days, which means option theta keeps on increasing as and when you progress towards the expiry. Vega is one very important factor. It is positive when it goes up, it is negative when it goes down. Now let's take an example straight away. First of all, the definition measures the change in option price per unit change in volatility, and the example, if you are trading into 11,000 strike with a volatility of 11%, which is 1% move in volatility will impact the price by 5 rupees. That is, Vega is 5 rupees over here and option price is trading at around 100 rupees. What happens when Vega goes from 11 to 12? 100 rupee option will start trading at 105 rupees. Why? Because there is an increase of 1% in Vega of that particular option. So 11 becomes 12 and 100 becomes 105. What happens when Vega goes to 14? There is a jump of 3 percentage point in Vega from 11% to 14%, option becomes 115 rupees. And the last, if Vega suddenly crashes from 14 to 9, option price will become 90 rupees. Now this will happen without anything changing, without any time lapse, without Nifty changing, but only volatility cooling off. So this is the impact that can be seen in option price if volatility moves up and down. Let's understand the relationship between option price and factor. Spot price, if spot price goes up, the relationship on the impact on call option will be positive and the impact on put option will be negative. Time to maturity, as and when the time to maturity progresses, the number of days keep on reducing towards expiry. 30 becomes 29, 28, 27 and so on. It will have a negative impact on call option pricing and put option pricing as well. Volatility, as we talked about, if volatility goes up, it is positive for call option. If volatility goes up, it is positive for put option. As and when volatility cools off, it is negative for both call and put. Before we sum up, I will give you a small example. When do we see all these things coming into picture? For example, if there is a big announcement at around 10 o'clock in the morning that FM is going to talk about something in the evening at 3:30, volatility will sharply take off from 11% to 12%, because FM is going to talk about and it will be something important and serious for market, and the option pricing goes up. Suddenly there is an announcement that PM is also going to talk about something in the evening at 8 o'clock. Now everybody knows what happens at 8 o'clock when PM talks about. Volatility jumps again by a couple of percentage points from 12 to 14 and the option pricing goes to 115 rupees. Now this is a typical thing which happens on Friday, nothing comes in over the weekend, and on Monday we saw, although Nifty is up by 100 points, the option don't appreciate that much. From 115 rupees, option is still trading at 135 or 140 rupees. Why does this happen? Right? Because the volatility cools off from 14% to 9% straight away, as we saw in the example which was given in the PPT. Now, why volatility cools off? Because nothing has come off in the press conference by the finance minister and nothing has been spoken about by the PM on anything that will impact markets in the evening. So, volatility cools off from 14 to 9. Now, because of this, 25 rupees move is on the negative side on the option price. So, 115 rupees option, if Nifty moves up by 100 points, should have ideally been trading at 165 rupees, but because of the volatility impact of negative 25 rupees, it comes to 140 rupees. And now delta also plays a role. Delta takes away around 4-5 rupees from the option pricing. So 140 becomes 135, Ideally it should have been 165 rupees, but it is still trading at 135 rupees. So this is how option Greeks impact each other. This is how option pricing is impacted by all these Greeks and all the factors. So whenever you are trading, whenever you are taking a call into options, do make it a point that you understand Greeks very well and you understand the impact of Greeks. It should not happen that because it is not trading at 165 rupees and it's trading only at 135 rupees, you don't square it off and it comes down further. So always take a measured call, take a well-informed decision while trading into options. Do stay in touch with us for the next episode to come up. Thank you.